Good afternoon, everyone. We've just gone 12 o'clock. I will give it another minute so that some more people can dial in, but just to do some introductions. My name is Danielle. I work in the FX sales team here in Lloyds Bank Corporate Markets. And today I'm going to be doing the Markets Masterclass, an introduction to FX options. So there's a few things that we will cover, including the sort of basics of FX options, the terminology, the valuation of an option, as well as some option structure examples and an introduction to how to add options to your hedging strategy. I do have everybody on mute with videos disabled just because of the number of people on the call, but the Q&A and the chat functions are enabled. So if you have any questions, please pop them on the chat and I'll either address them as we go, or there'll be an opportunity at the end of each section as well as at the end of the presentation to ask some questions. The slides as well as the recording of this will be available in maybe 2 or 3 days time on the Masterclass website, and we'll pop that round through to you as soon as that's up and running. Right, we have a lot to cover, so I am going to kick off. So firstly, FX option basics and terminology. So what is an option? Well, an FX option is a contract between two counterparties, so usually between the bank and a customer. It gives the owner the right, but not the obligation, to buy or sell currency at a specific rate on a specific date in the future. So it often helps to think about an option as an insurance contract on an exchange rate. Just like the insurance on your car, for example, where you are protecting yourself against theft or damage, an option is an insurance on the FX rate, where you are protecting yourself against a worst case scenario. So similar to other types of insurance, if a circumstance arises where you need to use that insurance, you have the right to do so. But if those circumstances do not arise, you have no obligation to use the contract. So there are two types of options, as you can see. The first is a call option, and the second a put option. So a call option gives the holder the right to buy the underlying currency. So for example, a US dollar call option would give the holder the right to buy US dollars. A put option gives the holder the right to sell the underlying currency. For example, a euro put option would give the holder the right to sell euros. So the call option is the right to buy and the put option is the right to sell. So FX options work in currency pairs, just like FX forwards or spot transactions. So taking the example of sterling US dollar as our currency pair, a US dollar call option gives you the right to buy US dollars. But if you are buying US dollars, you are also selling sterling, right? So the right to sell sterling is in fact a sterling put option. So therefore, a US dollar call option in this example is the same as a sterling put option. You have the right to buy dollars and to sell sterling. So the terminology can be used fairly interchangeably and together. If we then look at the components of an option. So firstly, we have the expiry date. So that is the last date to which the option is valid. It's usually the date at which we determine the outcome of the option. The strike rate. So this is the exchange rate applicable to the option contract. The notional size, that's the amount of currency. And the premium, which is the cost of the option. So looking at a quick example to put that into context, company ABC, they buy a sterling put and a dollar call, the right to sell sterling and the right to buy dollars on a notional of £1 million with a strike rate of 1.23 and an expiry date of 28 June 24. So come the 28th of June 2024, company ABC will have the right to sell £1 million, buy US dollars at a rate of 1.23. And to obtain this right, they need to pay a premium, and that premium comes to £14,000. So let's look at the circumstances where company ABC will exercise this option. So they will exercise this option when it is beneficial to do so, right? And the benefit will be determined by the market rate. So the option has given company ABC the right to buy US dollars and sell sterling at 1.23, their strike price. If we look at the blue line where the market rate has gone to 1.30, on expiry, company ABC has a choice. As per their option contract, they can use the spot market, they can sell £1 million at the strike rate of 1.23 and receive 1.23 million US dollars. Or they can use the spot market to sell £1 million at the market rate of 1.30 and they would receive $1.3 million. So in this example, it is better to exchange in the spot market and let the option contract expire unutilized. If, on the other hand, the spot market is trading at 1.16, the red line in the graph, it would be better to exercise the option and receive 1.23 million US dollars rather than to trade in the spot market and receive only 1.16. So you can see whether to exercise the option or not is determined on the expiry date in relation to where the market is trading and if it is beneficial for the company to do so. Okay, so let's take a look at the different types of options. So there are 4 types of options, mainly referring to when the option may be exercised. So a European option can be exercised at expiry only. This is similar to the example we've just run through and is also the most traded type of option. An American option, on the other hand, can be exercised at any time up to and including the expiry date. A Bermudan option refers to specific dates throughout the life of the contract when the option can be exercised, so perhaps at the end of each month over 6 months. And an Asian option is where the benefit of the option is determined on the expiry date, but it's dependent on an average of a specified rate throughout the life of the option, as opposed to the spot rate in the previous example. So I also thought it worthwhile highlighting a couple of reference rates. So these help to sort of analyze the effectiveness of an option. The first one is the break-even rate and then the effective hedging rate. So both are determined by adjusting the strike rate to account for that option premium that needs to be paid. So the break-even rate would be the spot rate that achieves the same outcome at the option contract as the option contract after accounting for the premium. So essentially, if the spot rate is at 1.2475, as per our example at expiry, the buyer would be indifferent between using the option contract and using the spot market. The effective hedging rate is the all-in rate after accounting for the premium. So your contract is to sell £1 million and receive $1.23 million, but in effect, your actual cost is £1 million plus the £14,000 in premium. So your effective hedging rate is in fact 1.2130. These are always beneficial when you want to, for example, compare the outcome to a forward contract. Okay, the value of an option. So um, let's consider how an option is valued by looking at the components of an option. So the components um, of an option's price or an option's premium, as we've referred to it, are split into 2 sections, into the intrinsic value and the extrinsic value. So the intrinsic value will be the value contained in the option due to its internal components. So it's determined by the difference between the option's strike rate and the current market spot rate. The extrinsic value, on the other hand, is mainly associated with time value and volatility. So an option may have no intrinsic value, but it may still have some value because there is still some time to expiry, which means that there is still time for the market rate to move and still time for the option to potentially obtain intrinsic value. So we include volatility in this because if a currency pair is more volatile, meaning it tends to move up and down more quickly, the likelihood of it moving such that the option obtains intrinsic value would be higher. So the more time there is until expiry and the more volatile a currency pair, the more extrinsic value an option will have. As time passes, the extrinsic value will decrease until we reach expiry, where there will be zero extrinsic value. Right, we then have the terms in the money and out the money, which we use specifically when we are referring to intrinsic value. So an option is in the money if it has intrinsic value, and it is out the money if it has no intrinsic value. So if we have a look at this graph and maybe refer to our running example where we have purchased a US dollar call option, so the right to buy US dollars at a strike rate of 1.23. So if the spot rate is trading at 1.2250, we have 50 pips of intrinsic value because we have the right to buy at 1.23, where spot market is trading at 1.2250. So the difference is 50 pips, and that represents our intrinsic value. If the spot rate, however, is trading above 1.23, there would be no intrinsic value. You may have extrinsic value if you have time to expiry, but there would be no current intrinsic value to that contract. Okay, so let's put options, now that we have some background on what options are and how they are valued, let's put that into the landscape of hedging strategies and analyze in terms of participation in favorable moves, which we have on the y-axis over there, and protection against adverse rate moves on the x-axis at the bottom. So at the bottom right-hand corner, we have a forward contract. So a forward contract is an obligation to trade at a specific rate. So you have full protection, you know exactly what rate you're going to trade at, and that is agreed. However, you have no flexibility. So you must transact at that forward rate, regardless of where the market is at expiry. So very high protection, but no participation. An option contract, however, in the top right-hand corner, gives you full protection because you know your worst case rate at the strike rate. It also gives you full flexibility. It allows you to participate in favorable moves. However, to gain that privilege, you do need to pay the option premium. In the top left-hand corner, we have low premium options. So that's essentially an option with a relatively low cost because it has a strike rate that is quite far from the current market. It's far out of the money. It may have no intrinsic value at all, but it may have extrinsic value due to the time to expiry. So it'll have little protection because the strike rate is very far from the current market, and thus the option has quite a low probability of being exercised. But it's got full flexibility. It allows full participation in favorable market moves, and it has a low premium price attached to it. A good way to think about an option like this is sort of like a disaster insurance. Many corporates were using low premium options in the lead up to Brexit, for example. And then the large circle in the middle over there is our structured strategies. So this refers to a large range of different strategies that offer a degree of protection and a degree of participation. So lying somewhere in between that forward contract and that pure vanilla option strategy. I'm going to go through some examples of structured strategies next, but I'll just pause for a minute, maybe there to answer any questions if they do pop up. Hopefully a lot of that was heard before or known to many of you, or if it is your first time hearing it, hopefully that makes sense. Okay, yes, we've got a hand up. Dougie, I'm not sure I can take you off of mute. Are you able to pop your question into the chat? Or Kim, I'm not sure. Can you take Dougie off of mute? Oh, wait, maybe I can. Dougie, can you hear me? Are you able to ask your question? So he says for moneyness, wouldn't for call option the spot above the strike be in the money and vice versa? The graph shows differently. Okay, apologies. Let's go to the graph again. Right. So for a call option, the spot above the strike be in the money. So when we talk about moneyness, we're talking about the product itself, right? So the option is the option in the money. So if I have the right to buy dollars at 123, but the market is trading at 123.50, then that option would be out of the money. So I think in the graph, sorry, as you have recognized, it's got both a put option and a call option there. So at 123.50, a US dollar put option would be in the money because a put option is the right to sell dollars. So if the market is trading at 123.50, and you have the right to sell at 1.23, your put option would have intrinsic value. On the other hand, a call option would have intrinsic value if the market was trading lower than where the strike is. So I've got both put options and call options on that graph, which I think may be causing the confusion there, but hopefully that makes sense for you now. Great. Okay, so let's go on to our examples of FX option structures. So probably worth saying up front that the world of option structures is vast. I'm going to run through just 3 of the more common structures, but worth highlighting that many different variations of these do exist. It's always worthwhile chatting to your salesperson about your flows, about your targets, about your risk appetite, and then they would be happy to produce some ideas that tend to align more with your specific scenario. But let's run through just a couple of strategies. Okay, so the first strategy would be a cylinder. So this is also known as a risk reversal or a collar. So by way of example, which is always easiest, company ABC has a requirement to sell sterling and buy US dollars. So they need to buy 1 million US dollars and they enter into a zero premium cylinder. So a cylinder is built up of 2 options. The first option is where company ABC buys a US dollar call and a sterling put option, a right to buy dollars and sell sterling with a strike rate of 1.23, an expiry of 28 June 24, and for this they need to pay a premium of £14,000. Simultaneously, then company ABC sells a US dollar put sterling call option. They would sell this back to the bank with the same notional, $1 million, and the same expiry date, 28th of June 24. And they want to make this a zero premium structure. So the premium on this needs to, again, be £14,000. So they need to receive the £14,000 from the bank. And we use that premium to back solve and determine the strike rate, which comes to 1.29. So we combine these 2 options and we achieve a single option structure known as a cylinder, which is a notional of $1 million, an expiry of 28 June 24, a cap or upper rate of 1.29, and a floor or lower rate of 1.23. And importantly, there's no premium paid by the company. So let's look at the characteristics of a cylinder. So we've got the floor rate, as I said, of 1.23. This is the worst case rate. Company ABC is fully protected against moves below this market rate of 1.23. Then the cap rate of 1.29. Again, the company can participate in favorable moves up to 1.29, but cannot achieve a rate higher than 1.29. They're capped at that rate. So if the market rate at expiry is between 1.23 and 1.29, 1.25, for example, then the company can purchase dollars at that market rate at 1.25. But if the rate is above 1.29, they have to purchase at 1.29. It's always worthwhile comparing these strategies to the forward. So I calculated the equivalent forward rate there, which would be 1.2646. So therefore, the protection rate of the cylinder of 1.23 is 3.46 cents lower. So effectively, the company is giving up 3.46 cents in protection versus the forward contract, but they gain that ability to fully participate in moves all the way up to 1.29. So hopefully that is fairly straightforward. Any questions on a cylinder? Feel free to pop them in the chat. I will move on to a participating forward. So let's adjust our example slightly here and consider a scenario where company ABC has an FX requirement to buy $1 million at the end of each month from June to December 2024. And the company enters into a participating forward. So a participating forward fully protects the company from adverse moves in the rate on the total protected notional, so $1 million per month. And it allows full participation in favorable moves on a portion of the notional. So 500,000 in this example, or 50%. So your protected notional is $1 million a month. Your locked in notional, where you are obliged to trade at that strike price, is $500,000 per month. And you've got an expiry at the end of each month over those 7 months. So that strike rate of 1.24, that is where company ABC is fully protected against moves below this rate. On that full notional of $1 million per month, this is the worst case rate that is known upfront. But the company is only locked into 50% of this, 500,000 per month at this rate. So if the spot rate is trading higher at expiry, they'll buy 500,000 at the strike rate of 1.24, and they can purchase the remaining 500,000 at the more favorable spot market rate. Again, this is a zero premium structure. Another way to think of this particular structure is that it is essentially a forward contract on half the notional at 1.24 and a full vanilla option on the other half of the notional. So you're obliged on half and you have full protection and full participation on the other half. It's also quite a useful structure when there's some uncertainty about your total notional. You can fully protect a larger notional, but you're only obliged on a smaller portion, which can be useful in some scenarios. Again, if we compare this structure to the forward contract, the protection rate of 1.24 is lower than the average forward rate of 1.2650. So essentially, the company has given up 2.5 cents in protection versus the forward for that ability to fully participate in favorable moves on that portion of the notional. I'll pause again very quickly to see if there are any questions on the participating forward. Okay, our last structure that we'll look at today is the forward extra. It's quite a popular structure, and it introduces what we call a knock-in option. So this is an option that only becomes live should the market spot rate reach a certain level in the specified knock-in period. So again, if we return to our example where company ABC has an FX requirement to buy $1 million per month at the end of each month from June to December 24, and the company enters into a forward extra. So we have a strike rate of 1.24 and a knock-in rate of 1.34. And that knock-in rate is valid during the knock-in period for each month. And that knock-in period is the start of each month until expiry. So you'll essentially have 7 knock-in periods that each become live at the start of the month and until the expiry of that specific month's trade. So a forward extra allows company ABC to participate in favorable moves from 124 all the way up to 134, similar to what a cylinder might have done. However, if the spot market rate trades at or above that 134 at any time during that month, company ABC must buy the dollars at the lower protection rate of 1.24. So unlike a cylinder where you're just capped at that 1.34, the forward extra knocks the company back down to a rate of 1.24. So essentially you may be in the scenario where spot market is trading significantly higher at 1.34, 1.35, 1.37, but you are then obliged to transact at 1.24. However, you do have that participation from 1.24 all the way up to 1.34, and you are fully protected from moves down below 1.24. Any questions on the forward extra? Again, these are just 3 types of structures. In the world of options has got many, many different types of structures. And it really is worthwhile talking to your salesperson if you want to find out more about options, if you want to find out more about the types of options that are out there. It's our job to produce ideas that align with your requirements and your targets. So definitely worthwhile raising to your salesperson if you are interested. I heard some noise. Is there a question?
Sorry, Daniel, it was me. I was just going to ask what makes the forward extra so popular, just from your insight.
Yeah, thanks, John. So probably the levels that you can achieve on a forward extra, if you had to compare them to a cylinder, for example, the levels that you might in the same market environment, the levels in a cylinder might be quite restrictive. So you may only have sort of 5 cents difference between your capped rate and your floor rate on a cylinder, whereas a forward extra tends to have a larger difference between those two. So your floor rate might be the same as the cylinder, but your capped rate could be 10 cents higher than where your floor rate is. So that it gives you more participation up to higher rates. However, you pay for it with the fact that it is a knock-in option, and you could be trading much lower down at that floor rate should the market go significantly higher. So it tends to look quite nice in a lot of situations, depending on market levels, really. But the kind of participation levels compared to the cylinder tend to come out a bit nicer, that people are quite like it. It's quite a simple structure too, that's fairly easy to understand. And the way I always like to think about it is, as long as you're happy trading at that worst case scenario, everything else can be a benefit. So that worst case scenario should be should be an okay rate to put into your books. You should be happy with that. Hopefully that answers your question.
That's great. It does. Thank you.
Okay. Is there anybody else who has a question? So let's just take a look quickly at adding options into your hedging framework and how you might think about doing something like that. So if we look at, sorry, 1 second. So if we consider hedging framework by looking at two market aspects, the first being the spot market rate. So that's on the x-axis there, and the second being the forward points, which is there on the y-axis. So there are scenarios that might occur where your spot market rate is favorable, but forward points are relatively unfavorable, or vice versa. So if we tend to think about the market environment in that way. So on this slide, if we concentrate on the block in the top right-hand corner, so this is the scenario where your spot rate is favorable and your forward points are favorable. So essentially the market conditions are very favorable to the type of trade that you're wanting to do. So you may therefore consider locking in your full requirement using a forward contract. So the slide states they're using forwards at the top of your policy range. So this refers to the situation where a company may have a policy to hedge between 80 to 100% of your forecasted exposure 1 year forward. So therefore you want to go to the top of your policy range here because market conditions are very favorable to do so, and the forward contract rate is looking very good, relatively speaking. On the bottom left-hand corner, on the other hand, spot rates are relatively poor, forward points are relatively unfavorable, and market conditions are not looking very good, relatively speaking. So in this scenario, you may consider using options. The options would minimize your obligation at these relatively unfavorable rates, and also then allow you to participate in market moves if should the market move to a more favorable place. So for scenarios in the middle, it might be a combination of forwards and options, or an adjustment to the percentage of your forecast. So going to the bottom of your range, 80% rather than 100%, for example, or perhaps hedging a longer or a shorter tenor. So as with any hedging policy, the degree to which you might use options will come down to various unique factors for each country, for each company. So for example, your profit margins, the confidence that you have in your FX forecasts, your budget rates in comparison to where the current market is, or even, how many people are in your treasury team and the ability to take the time to manage your options book. So there may also be, certain one-off circumstances where options lend themselves quite well. If you have a very large but uncertain cash flow, for example, from an acquisition, perhaps. So at Lloyd's, we've got quite an experienced risk advisory team that can help to put together a treasury policy that incorporates, various products and looks at different market aspects. So if this is something that you are interested in, please do let us know. I'm a few minutes over, but I'll take that as a bit of an achievement that I didn't run too far over. I hope that was clear and that you've all learned something. I will pause one more time for any questions, but hopefully that was clear.
No, that was a great call, Daniel. Thanks very much. My just question was to the point that you said just about if this would be work that you'd be interested in, and just asking what the channels are to take that further, whether it be here or offline elsewhere.
Yeah, absolutely. So if you do have a contact on our FX sales team, you can reach out to them. However, what we'll do is send through an email after within the next 2 or 3 days with the recording of the session as well as the slides, and you can then reach out to reply via that email to reach out to us. Otherwise, my email is danielle.olivier@lloydsbanking.com. You're welcome to reach out to me. You can also go via your relationship manager within the bank, and we will be able to have sight of that.
Fantastic. Thanks very much.
I know there's probably a few of you that would be interested in some more sort of complex option structures and taking a bit more of a deep dive into those. So on one of our next masterclasses, maybe going into 2024, if you can believe it, we'll definitely put that on the agenda. So look out for that. Follow Lloyds Bank Corporate and Institutional on LinkedIn, and you will see the updates. Otherwise, your salesperson and your RD will continue to send the invites for these. Thank you so much for joining, and I hope you found it insightful. Bye-bye.